afterwards, and we're also recording this review. So if you feel like it's going a little bit fast, I'm sorry, but in order to get through all the material, we're going to have to push through some things a little bit faster than maybe some of you would like. But yeah, let's go ahead and do this. Let's see, slideshow from beginning. Okay, awesome. Let's do this. So just the quick outline of the test. Covers chapters 11, 12, and 13, and 20 questions, multiple choice. I'm assuming that's correct. If Dr. Holmes told you something different, then he's right, but going off of past tests, that seems to be the norm. Okay, so topic 11. This is capital budgeting part 1. So we have these three methods for determining whether a project is worth starting, or for a company to know whether or not this is a good project or not. So we have net present value, internal rate of return, and payback period. So just so you guys know, as I put these together, I really just went through like the main points of each chapter and pulled them in. And so if I missed something, I'm really sorry, but this is the best I could do. So hopefully these will hit the main things that you should know for the exam. So when considering a project, there are some ideal criteria that we should include in our evaluation of whether or not to accept a project. So the first thing is we should consider all of the cash flows associated with the project. We should also consider the timing of the cash flows. That means, are we going to get these cash flows in the next 5 years, or are we going to get these cash flows 20 years from now? There's a big difference between receiving $100 next year and receiving $100 in 20 years. So that's something that's very important to consider. And then varying levels of risk between projects. When we compare different projects, which one would be better, which one would not, we should have a way to measure how risky each project is. And the NPV, the net present value, and the IRR consider all of these, but the payback period considers none of these. All right, so you may be wondering, why do we use the payback period? Well, the first reason is because it is super easy to calculate. And we'll do an example where you can see that. Hopefully you're familiar with it already. And the other reason is that it's also easy to understand. If I'm a manager and I come up to my employees and say, we're going to do this project because it has an NPV of 50. What in the world does that mean? How much do we invest in it, versus like getting 50 additional dollars back in our present value? We can't really determine what that means. But if I tell you that we're going to do this project and the payback period is 2.5 years, you say, oh, okay, so however much we put into it, it's going to take 2.5 years to get that exact amount back. Now, take into account that that doesn't consider time value of money, it doesn't consider cash flows past that, and it doesn't consider the risk of the project either, but it does give us a good idea for how long it will take to earn back dollar for dollar our investment. Okay, any questions on that? Awesome. So let's do a quick payback period calculation. Let's see. Yeah. Okay, so this is asking what is the payback period for a stream of cash flows. Year 0, we know, is our initial outlay, right? So that's going to be the negative, or 102.4 is our initial outlay. So how long will it take to earn back $102.4? So if you take the first year of 47.4, and then second year of 43.1, that's going to give us, carry it, and we get 90.5. So we're not quite there. So we have to do another year, right? We know 58.4, that's going to give us above 102.4. So in order to calculate the fraction of year 3 that it will take in order to get our payback period, we're going to take 102.4 minus the first 2 years, 47.4 and minus 43.1, and that gives us what's left in year 3. And then we're going to divide that by year 3 cash flow, 58.4. All right, and I actually did this one before, and this is going to equal 0.2. Okay, so in year 3, it's going to take us 0.2, or 1/5 of the year, to get the rest of our cash flows. So our total payback period for the first year, for the second year, and then 0.2 for the third year is 2.2. Okay, does that make sense how we calculated that? This one hopefully is familiar to all of you, so let's keep going. Okay, so net present value. Like I said, I just pulled quick, my own intuition behind these. So the net present value is the present value of a stream of future cash flows minus what we pay for those cash flows. That's why it's called a net present value. All right, hopefully you've kind of been able to determine that on your own, but that actually helps us in some other things in the topics later on. All right, so let's do a quick NPV calculation for the same project. So this one, you can use your calculators for. In fact, I would highly recommend that. Okay. So with, we just use our cash flow function. If you don't have this calculator, hopefully you've already become familiar with how to do it on your own. And what we do is we take year 1, 102.4, and make sure that's a negative, and we plug that in for our cash flow at time 0. Then we plug in the other ones, 47.4, cash flow at time 1, 43.1, cash flow at time 2, 58.4, cash flow at time 3, and 16.2, cash flow at time 4. It says we have a discount rate of 14%, so we plug that in for our discount rate. And then solve NPV. It's going to give us 21.35. Okay? So from a management perspective, is this a good project to invest in? It is, right? Because it's a positive NPV. That means the present value of our future cash flows is greater than how much we put into it, is greater than our initial outlay. It's greater than our initial outlay by $21.35. So this is a good project to invest in. Now, if our, let's say our payback period for this project was 2 years. Remember back to our last problem, we found the payback period was 2.2 years. Would we invest in the project if, as management, we decide we're only going to invest in projects that pay us back in 2 years? We wouldn't, right? But that's one of the limitations of payback period, is it doesn't include all of the cash flows. And so management would have ended up rejecting this project that actually increases the value of their firm. So that's one reason why NPV is better to use than payback period when deciding to invest in a project or not. Okay, and that's what we got. So let's do IRR. Well, we'll do that problem in a second. So IRR is the discount rate where your net present value is going to equal 0. Now, if net present value is your present value minus your initial outlay, and that equals 0, then it's also, you can also infer that the present value equals your initial outlay at the discount rate that the IRR gives you. Okay? So, yeah, anyway, that's cool. Any questions about that? I just kind of threw that out there. Okay, good. Everyone understands that. Perfect. Okay, IRR calculation. So let's do the same numbers. In fact, I wonder if I can just calculate IRR. Yeah, I can. So all the cash flows are already plugged into my calculator. You would plug them in the same way. Solve for IRR, you don't have to have a discount rate because it is the discount rate where your NPV equals 0. So as we can see, the IRR of this project is 24.8%. So that's pretty awesome. Any questions about these ones? Okay, great. You guys are doing awesome. Okay, profitability index. I didn't really get a chance to do much with this one. Just know how to calculate it. It's your net present value plus your initial outlay divided by your initial outlay. And remember, if net present value is your present value minus initial outlay, it's basically the present value of your future cash flows divided by your initial outlay. So if your profitability index is greater than 1, that means you're earning more dollars per dollar you invest. So it's a good project. If it's less than 1, then it's a bad project because you're earning less dollars per dollar you invest, according to time value of money stuff. So any questions about profitability index? I don't have an example for it. Hopefully you're familiar with it. If you want to go back and practice it, it's in topic 11. Okay? Awesome. Let's keep going. Equivalent annual annuity. Okay, so independent versus mutually exclusive. If you've taken like Stats 121 or something, you should be somewhat familiar with these terms. Independent events means that, now if there's any stats majors in here and I say this wrong, please correct me. But as far as my understanding goes, an independent event means that if one event occurs, it doesn't affect the probability or the outcome of the other event. Okay, and if there are two events that are mutually exclusive, that means if you choose one event, you cannot choose the others. So for example, if you roll a dice and you get a 6, you cannot get a 3 in that same roll. They're mutually exclusive events, okay? So when considering projects, if you have two projects you're choosing from and they're mutually exclusive, if you pick one, you cannot pick the other. All right, so that's what mutually exclusive means. Replacement chain versus EAA. These are just different ways to value different lengths of projects and compare them, okay? And I know that there's a situation where if a project is repeatable or not, then one method is better than the other. And I believe if it is repeatable, you can use replacement chain. If it's not repeatable, you use equivalent annual annuity to do that. So equivalent annual annuity, I know I'm jumping around, but like I said, I didn't really have a ton of time to prepare what I was going to say. But as the ideas come to my head, I'll just say them. So equivalent annual annuity is very literal in its name. So equivalent, we know, means equal, right? So these are equal. And then we're looking at annual annuity. We know an annuity is a set of payments or a set of cash flows, right? We learned that at the beginning of the semester. So if they're annual cash flows, these are equal annual cash flows. So if we compare two projects and we look at their equal annual cash flows, we can tell whichever one gives us a higher annual cash flow, which one is better. I don't have an example for this one either. Hopefully you've already become familiar with these. But like I said, they're in the textbook as well. Okay, any questions on these topics? Yeah? Okay, yeah, sure. So his question was, his statement was, no, it was his question. Could you give us some examples of when you would use each situation? So if I have a project, or if I have two projects that I'm considering, and these projects are repeatable. Say I have $400,000 to invest, and one project costs $150,000, the other costs $300,000. But these are repeatable. I can repeat as long as I have enough capital to fund them. Then I can use the replacement cost method in order to compare these two projects. One of the projects I can do twice. And so I can, for however long the life of that project is, I can determine what those future cash flows will be if I do the project twice, and then discount those to a present value. And then with the other one, so say I don't have, say they're not repeatable. Say I can only choose one and I can only do it once. Then in that case, I would want to use equivalent annual annuity if these projects have different lifetimes. So I mean, those are the two situations I can think of. Does that answer your question? Okay, so now he's wondering NPV over IRR over payback period or profitability index, right? It's good to look at all of these as a management team to determine which ones are better or not. But for the most part, I believe NPV is the number one valuer that you use to determine whether or not to accept a project. Now, a question could ask you, according to the IRR or according to the payback period, which one of these is a better investment, in which case you would use whatever it asked you to. But NPV is pretty much the dominant method of comparing projects. So his next question is, when can you not use NPV as a comparison? To be honest, I can't think of a situation right now. Is there one that you guys know about that was in the textbook or something where you cannot use NPV? Okay, so if they have different term lengths, right? So if one project lasts for 3 years and one project lasts for 6 years, the NPVs aren't good comparable measures. What you would want to use is the EAA or the replacement cost, depending on other situations associated with those projects, right? Okay. All right, awesome. Okay, so that is topic 11, I believe, and we'll move on to topic 12. We're doing good, guys. Okay, so with this one, I'm going to show you basically each of these different steps that we take when doing capital budgeting. So a management team would want to do capital budgeting. So we've talked about NPV, we've talked about IRR, but now we're going to talk about the inputs that go into that and how to solve for those. Okay? All right, so with incremental cash flows, these are, if you see this term, this means the cash flows that are associated with that project. So how does our revenue change, right? A company already has revenue, but they want to know how much will this project increase our revenue, hopefully increase, right? Okay, let's see. Incidental cash flows. Okay, that's basically what I just said. Incidental cash flows are the ones that come as a consequence of accepting a project. Indirect costs, let's see, is that what that is? Or indirect cash flows. I remember what cannibalization is. Cannibalization is, say a company has a line of toothpaste, and they want to introduce a new high-end toothpaste, right, that is really cool to have in your bathroom. And they want to know, cannibalization would be, for management to consider, is how will this affect the sales of our other toothpaste that we sell? Will the sales go down? Will they go up? How will this new product affect those products that we already have? So that's what cannibalization is. I don't know why I wrote indirect. Sorry, guys. Let's see. So sunk costs. I already have the answer there. Sunk costs are not included in our cash flow considerations. And this is because we've already paid those dollars. So you guys have already paid your tuition. So if you drop out of school, like that you've already paid your tuition, shouldn't matter, right? I mean, it seems funny, but it's true when it comes to capital budgeting that costs you've paid in the past shouldn't affect decisions you make for the future, because they're already sunk, they're already gone. You're not going to get those back. So if you do a market study, 6 months ago for a project, then you should not consider that as part of your cash flow analysis. Okay, opportunity costs. Did you have a question? Yeah. I think they're the same thing. Yeah. So incremental cash flows are the cash flows that, because of this project, like these are the cash flows, all the cash flows that are associated with it. Incidental cash flows are specifically related to the project, and then these other ones are kind of like other results of accepting the project. I believe they're synonymous terms. Yeah. Like I said, I put this together as fast as I could. Okay, so opportunity costs. If instead of starting a project, you could have sold a piece of land that this project is going to happen on, then that would be an opportunity cost, right? That's revenue foregone for starting this project. So that should be included. Opportunity costs are included in capital budgeting problems. Okay, depreciation, we have the maker system, which is just a set system that depreciates things by percentage over time. You find it by asset cost times that year percent per year. And then you have straight line depreciation, right, where we have the asset cost or our depreciable asset, right, minus the salvage value. If there is a salvage value, it says to depreciate to, and then you divide it by the life of the asset. Hopefully you guys are familiar with this one already. And remember that depreciation is not a cash expense, right? You paid the cash when you started the project, but depreciation just accounts for that expense over time. So depreciation expense is not an actual cash expense. It just provides you a tax shield. That's why companies do it. Question? Yeah, great question. Okay, so he asked if there's a difference between straight line depreciation and simplified straight line depreciation. And if I told you no, then you would all freak out because there were tons of questions where you might have missed because you didn't discount it to 0, right? So there is a difference between these two. Simplified straight line wants you to keep the discount or the depreciation simple, where it will depreciate everything to 0, no matter what you think you can sell it for at the end. Simplified straight line depreciation discounts or depreciates your asset to 0 by the end of the project. Okay, regular straight line depreciation is to the salvage value, if there is a salvage value. Okay, or I guess there's always a salvage value. Sometimes it's 0. So yeah, that answer your question? Right, so his question is, if they say use simplified straight line, but they also give you a salvage value or an estimated resale value of the project, then you would use you would use 0 as your salvage value still, because they said use simplified. So always go with simplified if that's what they tell you to do. Okay, any other questions about this? Awesome. Net working capital, so it's the additional assets and financing needs to take on a project. So at the beginning, net working capital is going to be added to our initial outlay, right? So our initial outlay is going to be larger as a cash outflow. And then in the terminal cash flow, we're going to do a reversal, where we're going to, on our balance sheets, we reverse our net working capital, but it actually increases our cash flows. So that's a cash inflow at the end. Any questions about net working capital? Yeah. All right, so his question is, when we calculate terminal cash flow, do we just add back net working capital? And yes, we do. Just dollar for dollar, add it back. Yeah. Okay, what's the difference between net working capital and working capital? So I believe in this class it's pretty, they're used interchangeably. So if it says this will be your increase in working capital, or this is your increase in net working capital, you'll use it for the same purpose. Technically what it is, net working capital is your working capital, which is like your current assets, minus your current liabilities. So that's net working capital, is what it is. Yeah? So she asked, do we add net working capital to our costs when doing depreciation? The answer is no, we don't. With depreciation, we only use the depreciable asset, right? It's the cost of the machine or building, and then it's any sort of like installment fees that we pay on top of that. Anything that it takes that otherwise we wouldn't be able to run it, then we add that to our depreciable asset. Okay, and we'll see that. I think we'll see it in a second. Maybe not. But you don't include net working capital in that. Okay. Was there another hand? Okay, awesome. So tax implications. So companies are taxed on taxable income, right? Taking on a new project will create tax liabilities, and it will also create new tax shields. So new projects are going to include additional revenue as a tax liability. It'll create depreciation as a tax shield, and it will also, we have sale of old assets, right? At the beginning of the project, we might have a sale of an old asset, and then at the end of the project, we'll have a sale as well, which, depending on our book values, will give us a tax shield or liability. Okay, any questions about tax shields or liabilities? That should be, hopefully you're familiar with that already. Okay, so there's a 3-step process with evaluating cash flows. Let's see, what are those? Okay, so the first one is to evaluate what all of your cash flows are. We need to know our initial outlay, we need to know our differential cash flows, that means our annual cash flows, and then our terminal cash flow as well. Step 2 is assess the project risk. Typically in this class we use WACC. And then step 3 is to decide whether to accept or reject a project. Okay? All right, so these are just the equations I quickly put together to calculate initial outlay. Hopefully you're familiar with this. You'll have the purchase price plus any shipping and installation costs. And I think those are typically the costs we stick to in this class for our depreciable asset. Okay, so those are the two things that go into the asset that you're going to depreciate on whichever method they give you. Then you'll have working capital or net working capital, depending on what they tell you, and the net sale of an old asset, meaning the sale of the old asset plus or minus any tax liabilities or shields. Yeah, that should be in here too, huh? So if you have an opportunity cost, then you would add that to your initial outlay. So if there's, you could have sold this land for, $2 million, then that would be an opportunity cost of $2 million. You would add it to your initial outlay, which would increase your, how much you pay out at the beginning, right? Okay. Yes. Mm-hmm. Well, okay, so her question is, do employee trainings in order to use this machine, are those included in our depreciable asset? I believe in the example you're referring to, it is included, right? Yeah, because otherwise you wouldn't be able to run this machine, right? So that, I believe that's why it's included, is because otherwise you wouldn't be able to operate this machine. So that is included. Yeah? What did I say? Add the net sale of old asset. Yeah, you're probably right. Because if you make a profit on the sale of your old asset, that would decrease your initial outlay, right? Okay, good observation there. So her question was, wouldn't you subtract the net sale of an old asset? That's my mistake on these slides. You would subtract the net sale of an old asset, because if you make a profit on the sale of an old asset, then that decreases your initial outlay, decreases the amount that you have to put out at the beginning. So he's wondering, is this what you use when you calculate NPV and IRR? And this is your cash flow at time 0. Okay? I saw one more hand. Maybe you were putting on your jacket. Okay. Is that all? Okay, there. Yeah, so net sale, I'm just referring to, the profit made on the sale and any tax implications from that. Question? Okay. So, okay, let me restructure this again. So, sell an old machine for $30,000. You have a book value of $20,000, meaning you made a profit of $10,000 on it, right? So you pay taxes of 40%. So you have to pay out $4,000. So you made a profit of you made $30,000 from selling this machine, and you had to pay $4,000. So yeah, $26,000 would be the correct amount. Okay, great. Let's move on to annual cash flows. Hopefully I did all these adding, subtracting signs the same or correctly. Okay, so differential cash flows. You start out with your revenues from the project. You less any cost of goods sold or your operating expenses, whatever those are. And then you subtract out your depreciable your depreciation expense, right? The reason we do that is because it gives us a tax shield. We need to pay less taxes when we do that. So this gives us our earnings before tax, and we multiply that or we take out our taxes from our earnings before tax, gives us our net income, and then we do a depreciation reversal because, remember, it's a non-cash expense, and we're looking for annual cash flows. So we add back our depreciation, and this gives us our annual cash flow as a cash inflow. Okay. Any questions about this one? Hopefully I did all the signs correct on it. And the parentheses means negative. Okay. Except for this is an inflow. That actually means it's an inflow. Okay, so terminal cash flows. All right, we have our realizable salvage value, right? Whatever you feel like you can sell the machine for at the end. You have plus or minus any sort of taxes you have to pay, right? So if you sell it for less than your book value, that means you did not depreciate your asset enough. You paid too many taxes, so you get a tax shield. All right. A tax shield would increase your terminal value, but a tax liability, if you sell a machine for more than your book value, tax liability would decrease your terminal cash flow. You add back your working capital, and this is going to equal your terminal cash flow, and this is also a cash inflow. And remember that in the final year end of a project, your annual cash flow at time n, the final year cash flow of a project is going to be your annual cash flow at time n plus your terminal cash flow as well. So if your project lasts for 5 years, you found your differential cash flow for year 5 and you found your terminal value, then you add that terminal cash flow to year 5 when you calculate your NPV. Okay? If you keep them separate, then your calculator is going to think this project lasts for 6 years and it's going to discount cash flows incorrectly.
So do you times to do the whole tax thing, do you times the difference between the actual salvage value and the book value by the tax rate or 1 minus tax rate?
Okay, so he's wondering when doing the tax effects, do you multiply the, I'll just tell you what it is instead of restating it. So he's wondering about tax implications. So what you'll do is you'll take the difference between your sale value and your book value, and you'll multiply that by the tax rate. I don't think you would do 1 minus the tax rate. I mean, there's probably some sort of algebraic way that you could figure it out where you would, but I think in this case, you just multiply it by the tax rate and then add or subtract it depending on if it's a shield or a liability. Okay. Okay, great. So step 2 is assessing project risk, and this is basically our WACC, right, the cost of capital. And you guys remember this equation for calculating the WACC. It's the weight of your debt times the cost of your debt times 1 minus the tax rate plus the weight of your equity times the cost of your equity, right, which you can find using the CAPM equation. Okay, step 3, how do you make a decision? So you use the project risk, WACC, to calculate the present value of your future cash flows, and you would use it to calculate NPV. And if NPV is positive, accept. If NPV is negative, reject. It's probably the most simple rule that you can follow in this class. So what if NPV is 0? What does that mean? Any answers? So you calculate everything, NPV turns out to be 0. What does that mean? You break even. Okay, so break even. Right, you don't add value, you don't lose value. You're pretty much indifferent to accepting this project or not. Yeah? Do you have a...
Like investing in something that grows exactly with, it's essentially making the value exactly the same. Your purchasing power is exactly the same from time 0 to time.
Yeah, so he's saying, this is basically telling us that our purchasing power is the same from time 0 to time whenever this project ends, right? Yeah, I think that's a correct assumption to make. I haven't heard it put that way, but I think that feels correct to me. Now, if NPV is 0, does that mean we should reject a project? Not necessarily. What if, what if our WACC was 20% and we invest $100 billion in this project and our NPV comes out to be 0? Well, that means we just made 20% annually on a project. On $100 billion, that seems pretty good. Now, as a company, if they find one that NPV is positive on, they would probably rather take that. But, they're still making 20%. So, just so you guys know, that's kind of what NPV of 0 is telling us, okay? Okay, any other questions on this part? Okay, let's do it. Now, I hope this covers everything. I just looked at one that looked like it did, and we're going to see if it has everything that we need. So, let's see. Louis Leisure Products is considering a project which will require the purchase of $1.3 million in new equipment. Okay, so I'm just going to start writing these numbers down. 1.3 million in equipment. Shipping and installation will be an additional 100,000. So 0.1. That's okay. For tax purposes, the equipment will be depreciated straight line to a salvage value of $175,000 over the 7-year life of the project. Okay, so I'm going to put that over here as far as my as we calculate our depreciation. Okay, so we know it's going to be a 7-year project to a salvage value of 0.175. So I'm doing these in millions, just so you guys know. Okay, let's see. They expect to sell the equipment at the end of 7 years for $280,000. Okay, so as I go along, I just kind of build out how I'm going to do this problem. I'm going to have my terminal value over here. I'm going to have years 1 through 7 in the middle. If I'm on Makers, I break it up. So I have year 1, year 2, year 3, and I break up how many years I'm doing. But since it's straight line, typically cash flows wouldn't change in these problems, and so we can just do them all together, and then we have our initial outlay, right? Okay, so terminal, we know that we're going to sell for 280, so I'm going to put 0.28 as sale. Okay, so this just makes sure that as I go through, I don't miss any important information. So annual sales for this project are estimated at 1.2 million. So 1.2 in revenue. Operating costs is at 750,000, so 0.75 for operating expenses. Can everyone see this okay? Zoom in a bit. Okay. Net working capital is equal to 20% of sales, will be required to support the project. So for our working capital amount, we're going to have 20% of our sales. So 0.2 times our revenue of 1.2 is going to be $240,000. So we can put that up here for our working capital. I guess it calls it net working capital in this, right? Which is included in our initial outlay. So in fact, I can transfer that right now. So 1.3 for equipment. Then we have 0.1 for shipping and installation. Now, remember, the depreciable asset is the equipment and the shipping costs. So our depreciable asset is 1.4 million. So depreciable asset. Okay, and then we have our net working capital of 0.24 on top of that. Okay, all the net working capital will be recouped at the end of the project, so we can put 0.24, 0.24 of our net working capital at the end. Yeah. Right, so she's wondering if you're not doing all of it, if you're not recouping all of it at the end, then you do whatever percentage that they give you, and yeah, that's true. You just do what they tell you to do. So it says in the problem, in the middle, it says that net working capital equal to 20% of sales will be required to support the project. So we know sales are $1.2 million. It says it somewhere right there. And so 20% of sales is 1.2 times 20%, 0.24 million. Yeah? Okay. Then we have the firm desires a minimum of 14% rate of return on this project. So we know that 14% is our discount rate, or our WACC. And the taxes are 34%. What is NPV? Okay, cool. So I believe we have everything now. So to find our, let's see. So we have our total initial outlay. 1.4 plus 0.24 is 1.64 for our initial outlay. 1.64 million. Then let's go ahead and figure out our differential cash flows. So we have our revenues, we have our operating expense, and now we need to figure out what our depreciation is going to be. So we know that our depreciable asset is 1.4 million. So I'm going to do depreciation up here. Okay. So our depreciable asset is 1.4 million. We're going to minus the salvage value of 0.175. And then we're going to divide that by the life of the project, which is 7 years. Okay? Did someone calculate that and they can just shout it out? Okay, so 0.175. Oh, just perfect. Great. So we minus 0.175 for depreciation expense. Okay, and this is going to give us our earnings before taxes. .275. Thank you. So it's 0.275 for earnings before taxes. Then we're going to take out taxes from it. Oh, sorry. Thank you. So we're going to take out our taxes, right? So our tax rate is 34%. So we take 34%, 0.34 times 0.275. We're going to subtract out 0.0935 in taxes. Sorry, we're getting drawn out in our decimals. But that's going to equal 0.1815. Then we add back our depreciation. So this is net income. We have our depreciation reversal is what I call it. Depreciation reversal of 0.175. So we add that back in. And this gives us our annual cash flow. So 0.3565 for our annual cash flow. Okay? So now we have that, and that happens for 7 years, right? Did I miss something, or? Yeah. Yeah, sure. So what we're looking for is how will our cash flows change as a result of doing this project, right? So as we look at our annual cash flows, this depreciation expense that we include on an income statement, that's not an actual cash flow. Depreciation expense is just a way that we account for buying this machine at year 0. Okay, so we actually spent this money in our initial outlay, but we don't account for it in our income statement right away. We draw it out over the life of the project because it gives us some tax benefits as we do. So we take out depreciation because it gives us a tax shield. And then we add it back in because it wasn't an actual cash flow, and that's still like cash that's in our, that's as a result of this project. Yeah? Okay. And then our terminal value, we have the sale of 0.28. we have the net working capital of 0.24, but do we have any tax implications from the sale of this machine? We do, right? So the salvage value we know is 0.175 for our salvage value. So in order to solve for our taxes, we take the difference between the sale and the salvage, so 0.28 minus 0.175. We're going to multiply that by the tax rate of 0.34. All right, so 0.28 minus 0.175 times 0.34 equals, so we're going to have to pay an additional 0.0357 in taxes. Okay, because we made a profit on the sale of this machine, we pay an additional amount in taxes, so we're going to subtract that from our terminal value. So 0.28 plus 0.24 minus 0.0357 is going to equal 0.4843 is our terminal value. Okay, so let's go ahead and solve this on our calculator. So we have, actually, you know, before I do that, I'm going to add together these two to get our year 7 cash flow, right? So really, these are years 1 through 6 cash flows, and then year 7 is going to be this amount plus this amount. So 0.3565 plus 0.4843, 0.8408. Yeah. Right. Yeah, so he's wondering, did we calculate the depreciation? So we took, or how we calculated it. So we took the depreciable asset of 1.4 million, we minus the salvage value, and we divided that by 7, and that gave us 0.175. It just happened to be the same number. Yeah. Question? Okay, so this is our terminal value. So you take the sale of 0.28 for the sale of the equipment. Then you have your net working capital reversal, right? So you add that to it. And then you subtract the taxes that we have to pay from the sale of this old machine. So we had to pay 0.0357 million in taxes. So that's how, I believe that's how we got that. You don't have to pay taxes on net working capital. Yeah. How did we get the taxes? In terminal value? Or which one? This one? Okay, so what we did is we took our earnings before taxes and we multiplied it by the tax rate of 34%. And that gave us that amount. Yeah. Okay. So she's wondering if this is a tax shield or a tax liability in our terminal value, right? So this is a tax liability because we made a profit on the sale of our machine, or equipment, I guess. So the book value of our equipment was 0.175, but we sold it for 0.28 million. So we have to pay taxes on that profit. Okay, I'm going to move on just because we're running. I'll go a few minutes over just because we didn't start till about 5 after. But let's go ahead and calculate NPV. All right, so we have an initial outlay of let me just clear my calculator. So our initial outlay is 1.64. Be sure to make that a negative as your cash flow at time 0. Then we have incremental cash flows of 0.3565 per year, and we have it for 6 years. So I'm going to do 6 for CFN1. Okay, so that means that cash flow happens 6 times. Then we have our cash flow at year 7 of 0.8408 is our cash flow at time 7. We have a 14% discount rate, gives us an NPV of 0.0823 or 0.082 million. Okay, this is a positive NPV project, and we should accept it. I believe I did everything correctly. Did anyone catch anything that I might have messed up on? Oh, really? Let me just back up a bit. Okay, yeah. So I put realizable salvage value, which means the actual price that someone will pay for it. Yeah. Yeah. It is not actual salvage. Yeah. Thank you for pointing that out, though. So the realizable salvage value is the amount you sell it for, not the actual salvage value. Realizable salvage value is what do we actually realize when we sell this machine. Okay. We really want to move on to firm valuation. Are these questions TAs can answer? Okay, awesome. Thanks, guys. So firm valuation. This is basically like everything accumulated together. If you want to value a firm instead of just a project. So we have these different methods for valuing a firm. We can use replacement cost method, which basically means we treat it as if it were a project. You have some amount of cash flows, and then you sell the entire firm at the end of however many years. And that would be your replacement cost. How much would it cost to actually replace this company? Then we can use discounted cash flows method, which is where we take future cash flows and we have some sort of terminal value where we have a perpetuity of growth, and we calculate the present value of that. Or we can use comparable multiples where we compare a company that's similar to it and use their ratios in order to determine the value of the firm. If you want to value the entire firm, so this is referring to our discounted cash flows method. To value an entire firm, you want to use the free cash flows to the firm. And to value just the equity of the firm, you want to use free cash flows to equity holders. That's what the discounted cash flows will give you. Yes? Oh, so you're wondering where we got that for terminal value? Or which one? Okay, just gotcha. Okay, was there another hand? Okay. All right, so let's do it. I don't believe there was much more than just actually calculating these that was in this chapter. So let's go ahead and do it. Let's see what these say. So Verizon Communications has $13.44 billion free cash flows in the most recent year, or free cash flows to the firm. So FCFF is equal to $13.44 billion. If the firm's expected growth rate is 5%, its WACC is 10%, and the cost of equity is 13%, what is the value of Verizon? Now, we're using free cash flows to the firm. So which discounting which discount rate are we going to use? Are we going to use the WACC or the cost of equity? We're going to use the WACC, right? If they gave us free cash flows to equity holders, we would use the cost of equity, okay? So it's telling us there's a growth rate. So what we want to use is the Gordon growth method, right? Do you guys remember Gordon growth as we have our cash flow times 1 plus the growth rate divided by, we're going to say WACC minus growth rate. Okay, so this gives us next year's cash flow, and this gives us the WACC minus G. So, I don't know why I said that. Okay, so we have cash flows of 13.44, and since this was the most recent year, we need to find next year's cash flow. So you multiply it by 1 plus the growth rate of 5%, so 1.05, right? Yeah. And then you divide it by WACC of 10%, so 0.1, minus G of 0.05, so 0.05. And then you just calculate that. So 13.44 times 1.05 equals that, divided by 0.05 equals 282.24 billion. I don't know what Verizon's actually worth right now, but that is a lot of money. So it's pretty good. It's almost the value of Johnson & Johnson. Okay, so I mean that's basically how you do that one. Any question? Yes. Sure, yeah. So when we're dealing with free cash flows to the firm, remember this is the cash that's available to both debt and equity holders, right? And so a firm is completely valued through either debt or equity, right? And so when we use free cash flows to the firm and we calculate the present value of those cash flows, that's going to give us the value of the entire firm because it includes both debt and equity cash. If we use free cash flows to equity holders, that's only cash available to the owners of the firm, to the equity owners. And so you would use the cost of equity in order to discount that. Right, so he's wondering if they gave us free cash flows to equity, in order to calculate the firm value, we would have to then add in their debt value in order to find the value of the entire firm. That's correct. You know, I'm going to keep going. We have another question over here for a TA. So keep raising your hand. They'll get to you. Sorry, yeah, I really got to keep going.
Will you give us the WACC that's towards the end?
You may have to calculate it. Yeah. But you already know how to do that, so it's awesome, right? Okay. All right, let's do equity value. So this was an example doing equity. Okay, Procter & Gamble has $10.11 billion in free cash flows to the firm. Its book value of debt is $75 billion and market value of debt is $73 billion. 2.7 billion shares of P&G stocks are outstanding as of now. If the estimated growth rate of the company is 3% for the foreseeable future and has a WACC of 8%, what is the price per share of P&G stocks? So they give us the free cash flows to the firm, but they want us to find the value of the stocks, which is just equity, right? So what we're going to do is we're going to find the value of the entire firm first, and then we're going to subtract out the debt, and that's going to give us the total value of their equity, and then we can figure out what the price per stock is, okay? So I'm just going to kind of pound through this. So we have $10.11 billion in free cash flows to the firm, and the estimated growth rate is 3% for the foreseeable future, so we're going to multiply that by 1.03, and we're going to divide it by the WACC, since they gave us free cash flows to the firm of 8% minus the growth rate of 0.03, and that's going to give us the entire value of the firm. So that equals 208.27. Okay, now this is the value, 208 billion is the value of the entire firm. So to find just the value of the equity, we're going to subtract out the market value of the equity of 73 billion. So minus 73 billion we're going to subtract out the market value of the debt. So minus 73 billion for that is 135.27 billion. Okay? Now we can solve, now we know the value of the equity, we can solve for price per share by dividing 135.27 billion by 2.7 billion shares. So divided by 2.7 billion shares equals $50.10 per share. Yeah? Okay, great. Yeah. Because you always want to solve for next year's cash flow. When using the Gordon growth model, you have to use the next year cash flow. You can't use today's because this is a discounting formula, and if you use today's, it'll discount it to last year, and we don't want last year's value. Yeah, it wasn't as clear in this problem, but yeah, it is. How do you know you have to subtract the debt? Well, the reason is because they gave us free cash flows to the firm. We use free cash flows to the firm to calculate the value of the entire firm, meaning both its debt and equity, right? So, but we want to solve for only equity in this case, right? They're asking us for the stock price. So in which case, we would take the value of the entire firm minus the market value of the debt, and that gives us the value of the equity for this firm, the market value of the equity. Yeah? So she says, how do you know use the market value instead of book value of the debt? Basically, it's because the market value is what someone's willing to pay for it, right? A firm's equity on their balance sheet is very different than the market value of that's traded on the stock market. Same with debt. Typically, debt is about the same as its book value, but it does fluctuate. So if they give you both, always go with market value.
Do you ever use the book, or is that just the...
He says, do we ever use the book value? Well, you use it if you're not given a market value. So yeah. Okay, there is one more. I'm just going to work this out for the sake of the video. But then once I'm done with that, then the review is over. So thank you all for coming. And I hope, well, I'll keep talking. So I'll thank you at the end of this. Okay, so the Silverman Sachs Group has a price to earnings ratio of 11.41. So our PE ratio equals 11.41. What is the PE ratio? Well, it is the price to earnings. So the price, meaning the price of our equity or the price of our stocks, divided by the earnings, meaning either the total earnings of the firm, of our net income, or the earnings per share, depending on what they give us. Oh, they give us earnings per share. So we know our EPS is equal to 17.07. So this means that for every dollar of, or for every share we have, we earn $17 on that share. So if this firm had one share of stock, that means their earnings were $17, right? Okay, so what is the price of Susie Bank stock? So this price to earnings ratio is going to give us a big clue. The price to earnings ratio is how much more someone's willing to pay for it than what their actual earnings are, okay? So if the earnings of a company was $1, then the price to earnings ratio means that someone's willing to pay $11.41 for ownership in this company's dollar of earnings. Okay, so what we can do, what we want to solve for is our price per share. So price to earnings ratio can be written as either, it can be written as price per share divided by earnings per share. Okay, so if we're given earnings per share, so we know that, so we know the price to earnings ratio is 11.41, and that's going to equal price per share divided by our earnings per share, and we know that is 17.07. So now what we can do is just use algebra, multiply 11.41 by 17.07, and that gives us the price per share of 194.77. Okay, so that's how you would solve that problem. And we're out of time, so thank you all so much for coming to this review. I hope it was helpful. Good luck on your test.